In the late 1990s, as the internet spread into homes and businesses, a new myth took hold on Wall Street: that any company with .com in its name was destined to change the world, and that the stock market, especially tech, would always trend upward in the long run. Venture capital poured into startups with untested business models, and the Nasdaq Composite Index soared more than 600% between 1995 and its peak in March 2000. Investors told themselves that traditional metrics no longer mattered. Profits could come later. What counted now was eyeballs, page views, and growth at any cost. With index charts climbing steeply, the idea that stocks always go up felt validated. Money flowed into any company associated with the internet, from online pet stores to web-based grocers, often regardless of whether they had a path to sustainable earnings. People borrowed to invest, quit jobs to trade full-time, and dismissed warnings about valuation. On March 10, 2000, the myth met reality. The Nasdaq hit 5,048.62, and then began a brutal descent. Over the next 2 years, the index fell by roughly 78% from its peak, wiping out about $5 trillion in market capitalization by October 2002. Famous .coms collapsed, from Pets.com to Webvan, and giants like Cisco and Amazon saw their market values plunge. Many retail investors who had believed they could simply ride out volatility discovered that entry price and business quality mattered after all. The damage went beyond individual portfolios. Pension funds, mutual funds, and institutional investors had also bought into inflated valuations, assuming that technology's transformative potential justified almost any price. When the bubble burst, confidence in equity markets, analysts, and even auditors suffered. Subsequent scandals at Enron and WorldCom further eroded trust, reinforcing the sense that the late 1990s boom had been built on shaky narratives rather than solid fundamentals. In retrospect, the .com crash exposed the stock market myth in stark terms. Indices can deliver strong long-term returns, but they can also experience lost decades and devastating drawdowns. Investors learned that buying at the wrong time, in the wrong sectors, with unrealistic expectations, can erase years of gains. Diversification, valuation discipline, and skepticism toward hype became key lessons, but only after trillions had vanished. The myth that stocks always go up wasn't born in the 1990s, but the .com bubble gave it its most spectacular test and failure. It remains a cautionary story about confusing long-term potential with short-term invincibility.